Okay, Outlook week 9, number 1. It's been a very volatile month, as expected, as discussed, predicted. Let's go ahead and start with the British pound futures. All right, so this has probably been one of the more mild pairs as far as price action today, but one of the most volatile pairs of the month. We covered a lot of ground here, shaving off at least 400 pips or 4,000 ticks, I think, if you're in futures talk. The green boxes are the entries that I had originally taken but ended up closing just to take profit. And so now the current price action is where we are, where we have solidified a price leg that happened to, or actually yesterday, or going into, what's it today? Yeah, last night. Okay, that was Sunday night. This happened Sunday night. Sorry, my brain's a little scattered right now. But anyway, we created this price leg after this impulse down. This break of structure led to the solidification of the price leg existing from this high down to this low, which generated the premium and discount side of the market. And because our bias is bearish, we look for premium plays, the best possible premium, just so happened to be this area of interest, which was in the process of this break of structure. And so if you got opportunities there, great. And so we would be looking for continuations from this area of interest to continue downward and our price action and continue our price action down lower, following the mitigation of this price leg here and then the break of this price leg to the low side. We're looking for the exact same thing happening. There's essentially there's no inefficient pricing left in this price leg. It's completely balanced. There's this price gap is balanced here. This price gap is balanced here. The price action above it is balanced. The price action below and above this on the discount side is balanced. So we're either about to pop or we're about to drop, with bias towards the drop to continue the current macro price action, looking for price to immediately take out this price leg, but then take out our 4-hour liquidity point here. And then the next target would actually be this low here, which actually lines up with, I think, a daily. Yeah, it's a macro liquidity point here. So our first target is this 4-hour, or our first target would be the low of the price leg. Second target, 4-hour liquidity point, then the macro liquidity point. I would be very, very, very cognizant and very aware of the actions that occur at this liquidity point, because this is a macro liquidity point. So if there's a break of structure here, oh, it's going to be very, very strong, the reaction, and we're going to head towards, these liquidity points here. But if this ends up being a draw on liquidity, we could expect some sort of pullback that would be a pretty decent sized pullback, just based off of this being a major draw on liquidity, or a macro liquidity point. A major draw on liquidity would lead to some sort of pullback here, and then we would have to assess the price action that occurs there. So that's what I'm seeing on GU. Gold has surprised me. So gold is actually pumping back into the area of interest that I'm looking at. We have not yet reached 50%. Actually, scroll down to the 4. We've not yet reached 50% to justify it being mitigated. So we're still waiting on that. But yeah, this price action, I was really expecting this to continue ranging this drop, but I kind of gave up on this area of interest. But nonetheless, it's pumping up towards our area of interest, and so we could be looking for opportunities here soon. 50% would be the ideal mitigation point, and then 100%, and then you can do whatever model you want to look for possible entries and opportunities. And then because we are in a range, what you would want to do is target the closest 4-hour liquidity point that is in the process of here to be conservative. Because we're ranging, there's a lot more volatility, a lot more economic action, a lot more economic activity and price action that's going to occur. So you want to be conservative with your targets, and I'm going to explain on the NASDAQ what I mean by that in more detail. But nonetheless, we're on gold. We're getting up to our area of interest here, and so yeah, we're going to see if we get some opportunities trading gold. All right, on to the NASDAQ. So I was extremely ambitious, not with the uh, overall decision to trade this pair, but the overall to hold a trade based off of this immediate draw on liquidity here. So I actually ended up getting a trade based inside of this wick here. I'm not going to go over the trade, but I thought that this was going to be the play that led to the run on this low, and then ultimately, this liquidity point, which is the low of this overall macro, essentially range and price leg. Well, that's not the case. And so I kind of went against, well, I did go against my rule here when I do trade in ranges. And like I just said on gold here, is when you're trading in a range, no matter what, if you have the best discount or the best premium, if you're trading inside of a range, if you've established it to be a range, you always, 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 based off my system, you want to take profit at the conservative and closest 4 hour liquidity point. And I went against that. I got extremely ambitious, and not over leveraged, but I over analyzed, or I was overconfident in where this price was going to go based off of the price action. I got a very sweet entry, very sweet response, and I should have taken profit at this 4 hour liquidity point here, which is exactly what price ended up responding from. And so as you can see right now, we've just getting draw on liquidity after draw on liquidity, but we're tending lower in the discount side of the market. Like I said before, I don't recognize this as a price gap. I would look more so at the actions at these liquidity points to play this right now, because this price gap didn't mitigate anything of of substance previously. So I would just stick to, and I'm not going to overanalyze it, but I would just stick to looking at the actions here. And so because of that, we got draws on liquidity, and the most recent draw on liquidity actually ended up being here. And so I ended up actually catching an opportunity here off of this green box that led to the run on this liquidity point. And so yet again, we have a potential draw on liquidity here, but I was smart this time and I took profit at this low. So I avoided, this pullback in price action here. And this allows me that if price action opens up, tomorrow, I'll be able to capitalize on another opportunity, considering that price would continue lower. But I have to take into account that this is a potential draw on liquidity. And if we do have this draw on liquidity, that price could look for aiming for some sort of liquidity point here, or we could aim for this liquidity point here, or the price action could fail, and that'll be determined on looking at lower time frame, like the 5 minute or so, to see if there's any sort of opportunities to capture for a price to invalidate the draw on liquidity here on the 4 hour time frame and continue this price action lower. All right, so that's what I'm seeing on the NASDAQ. Point taken, take away from this, take profit at the conservative liquidity points if you're trading inside of range. If you're trading in a run, you can do whatever you want. Hold it as long as possible. Wait for price legs to form. Take trades off of price legs as you're going down. But when you're in a range, be conservative. Be conservative, because the range is probably the most volatile and unpredictable um, phase to trade in. There's only two phases, so it's the unpredictable phase to trade in, which is why we want to be conservative. And it doesn't matter, get on my soapbox real quick, it doesn't matter if I caught this uh, trade up here, I would still want to take profit at this 4 hour liquidity point here. And that's because if I seen this come back, remember that we're still in a bullish run. So even though I'm taking a trade off of this, we're still, technically the macro bias is bullish. So this trade is counter trend. And so even though I'm analyzing it as if price is going to take out this low, remember this analysis is still counter trend. And so there's nothing stopping price from, holding this resistance and holding this level here, and then just absolutely taking off towards this high here. And that's just the volatility of ranges. So you got to be very, very cautious when you're trading ranges, especially if you're trading against the macro bias of a range. It's just err on the side of conservatism when you're trading ranges. All right, silver. All right, silver is also pumping. There's not really much to say on this. I'm actually going to leave that to y'all to, come up with scenarios and see what you want to do. And then we'll discuss it later. But I'm talking to my students here. But yeah, we'll do that. But I don't really know. I'm not really looking at silver. All right, Dow Jones, the pair of the month. I stated, I told you guys that I got opportunities here, or if I did not say it on video, I'm telling you guys now, I caught this opportunity here. I told you guys I was going to hold it until we reached the open of my area of interest, which is this 4-hour price gap here. Okay. And the reason why is because this is a counter trend trade, right? We're still looking at a bullish run. So any price action moving against the bullish run would be considered counter trend. And on top of that, this is a price leg. And so I was playing a hedge against the pullback, or really the impulse of this price leg, expecting price to fall and mitigate the last unbalanced area of this overall price leg. And so that's why I was hedging. I found this opportunity. I was like, okay, this looks like a great opportunity. It looks like we're setting up for a pullback. We have the unwillingness. Let me go ahead and take this trade. And it played out absolutely tremendously. And I took profit actually here. There wasn't really, I mean, yes, I could have taken profit at this liquidity point, but because the momentum, once again going against my rule here, but because of the momentum here, I was like, oh, I think this is going to hold for a little bit longer. So I held it for longer just to test the waters. But like I said before, err on the side of conservatism. Do as I say, not as I do. Take profit at your local liquidity point, 4-hour liquidity point. Don't just hold it unless you can absolutely justify that price action is going to, move in your favor. And so in this particular case, it actually did move in my favor, and it moved actually straight through my area of interest. So it invalidated my area of interest. And so now we're in a similar mindset to the NASDAQ or NQ, that we could potentially break this price leg. And if we break this price leg, then price is going to now break a macro liquidity point, and we will be inside of a bullish range. And then once that happens, we'll have to define, where the bullish range begins and where it ends. Well, we already know where it ends. It ends at this high if it breaks this leg. But then we'll have to, determine from the macro perspective where the bullish range begins, and then we'll have to look for the areas of interest, or the inefficiencies inside of that range. And at that point, that's going to be very interesting to see what price action does on YM. But as of right now, we have, this price action. I have this draw on liquidity marked up because I said I did not see this as a area of interest or as a price gap. And so I wanted to annotate what could possibly happen if price were, to pull back. If it did not go ahead and mitigate the area of interest as it was dropping, I would say, oh, it would have to generate some sort of liquidity. And where would that liquidity be? It would be an action at a local liquidity point. And so we got a draw on liquidity at this liquidity point here. And that is what led to the price action going lower. And so now what we're looking at, and I'll go ahead and get rid of all of this. I'll keep that on there for now. What we're looking at is a potential break of this liquidity, or of this the structural point, or of this price leg overall. And if we get that break of this price leg overall, like I said, we will transition into from a bullish run, because this is a macro liquidity point, into a bullish range. All right. So that's week 9 outlook number 1. Peace.